Today we're joined back by Ishtiaq from Abacus Accounts. We know it's your second podcast, Ishtiaq.
It is, yeah.
People were demanding more. They wanted
that's
an
good.
encore
Good to
from
hear.
yourself.
That's good to hear.
So I just thought we'd bring you in today. There's a lot of recent changes with your capital gains tax, stamp duty and things like that. So
Yeah, absolutely fine.
we just thought we'd iron out a few misunderstandings that a lot of people have got at the moment.
Okay.
Have you come across any misinterpretations of these new rules already?
So there's, over the last couple of months, there's been a lot of panic with property owners because they just didn't know what's going to happen with the capital gains tax rates. To some extent, residential side hasn't changed hugely in terms of the tax rate. It's pretty much the same, 18 and 24%. The big panic was that the tax rates are going to go up to 45% or 40% or in line with income tax, so 20% and 40%, and then the higher rate tax being even higher. And it hasn't been the case. So you'll have seen there's a couple of months ago, people are panicking to sell, and now it's calmed down a little bit because of the stability that's come in. So that's really good news for residential property owners.
I think as residentials, they're taking a big hit on the new renters right away coming in. The last thing they needed was
an increase in tax.
Yes.
Yeah. So I'm sure the government's looking into what the country needs and the stability of the property market, because to some extent, property is the backbone of the country. I mean, that's what I can see at this moment in time. The industry's reduced, manufacturing's reduced, and they have to support the property sector somehow.
People need houses.
Of course, yeah. I mean that goes without saying. So yeah, the income tax side on residential property is pretty much the same. Other areas have changed and they have gone up a little bit, which we can talk about later on. But in terms of residential properties, which is what you're interested in, and probably most of the listeners, it's not really changed hugely at all, which is good news.
And I think social media sort of fueled a lot of the fire.
Yeah.
Someone's misinterpretation of what's changed then becomes, gospel, and everyone's reading off
it's
that
like
hymn sheet.
wildfire, isn't it? Just
So has capital gains tax on your residentials not come down from 28 to 24%?
So, so it's at this moment in time, it's you're getting the CGT rates. So there's capital gains tax on residential property and other assets. Okay, so at this moment in time, it's still 24% and 18% on residential property.
And you wonder why people are confused.
Yeah.
We've had a look just before we've come in here, and the internet's saying it's down from 28 to 24.
So they're your rates at the moment.
Yeah.
I think what most people don't realise is good misconception here. We check on Google, but the key thing is to have a good accountant that will advise you. As a landlord, as a landlord and investor, what role do you play as an accountant to help him save and where he can save?
Okay. So again, first of all, you need to understand the individual's strategy in terms of what they want to do with the properties. Do they want to buy and sell? If you want to buy and sell, it's a different strategy and different vehicle that we use. If it's long-term investment, then it's a totally different way that you set up the structure for the individual.
I think the majority of our landlords retain theirs for a cash flow, for a cash flow producing
for that,
asset.
you're probably better off in holding it in a company.
Yeah.
If you try to buy and sell properties within a company, you've got two kinds of taxes you have to pay. One, the uplift of the value of the property in the company, and secondly, if you take the money out of the company, of which you've profited from, for example, then there's a further tax on that. So in most cases, it works out better if you're buying and selling to do that on individual names, on your personal names, because you've got capital gains tax allowances, and your CGT rate, of course, hasn't changed from before.
So flips in your own name, cash flow in a business.
In a nutshell, yeah.
Basically.
With exceptions, but generally that's what I advise.
Right, okay.
A question we get asked quite often on the sourcing side especially, what can I write off as an expense when I'm buying a property? How will this affect me if I'm working? It's just they're keen to buy properties, but I think the question that we get asked every time, what can I write off as an expense when I'm buying a property? What can I save, in essence?
Yeah. Again, fairly straightforward. And it's pretty clear if you go onto the government website, the expenses and so on. But you can include things. I mean, this is things that I'm just suggesting. You might have had a lot of help from your children, for example. And if it's in a limited company, as an example, if they've helped you out, if they've got personal allowances available, and they've helped in the project itself, in terms of working on the project, you could put them onto the payroll and give them a salary, for example. I know a lot of people, when they buy a property, the wife helps, you know, the children help, especially in the Asian culture. You get the whole family helping. Yeah, and you know, to some extent, you can say that they've been part of the construction side.
So, is there a limit to? Because I know that giftable allowance is what, £3,000 a year.
That's for the purpose of inheritance tax you're talking about, yeah. But
I mean, even if it was to purchase a property.
I think anybody can help anyone with whatever amount. You know, if my grandfather, my father wanted to give me £20,000, £30,000 to assist me in buying a property, absolutely no issues whatsoever.
Right.
So there's no limit on that. It could be £200,000.
Right. Okay.
So again, it goes back to the same thing. Within the Asian culture, everybody tends to help each other out, and you know, if there's a nephew wanting to buy a property, you know, the uncle will help, the father will help, and there's no issues in pooling in the funds from family.
Just going back to the beginning, because I'm sure this is a question where an average person would ask, just because of the lack of knowledge again. Can you simplify what is capital gains tax for a layman?
Yeah, okay. So if you buy a property for £100,000 or £80,000 rather, you spend £20,000 on refurbishing it and making it into a position that you can actually sell it at a profit. Let's say it sells for £200,000. The £100,000 gain would be taxed, and the tax on that gain is called capital gains tax. Simple as that.
As simple as that.
So on the 100,000, you'd pay. It depends if you're a low rate taxpayer on your personal side or a higher rate taxpayer, and it would be at the retrospective bands.
Would that make a difference even if it's in a business name, or?
If it's in a personal name, you just pay the corporation, the capital gains tax rate, and that's it. That's the end of the matter. Within 60 days, you've got to pay HMRC. Simple as that. If it's held in a company, the rules are slightly different. So the uplift in the value, you'd be paying corporation tax on that, which is a split between 19 and 25%, depending on the profits of the company. And then there's a further tax if you want to take the profits out of the company. It's the retrospective dividend tax rate, which could be up to, you know, the low rate is 8.75% and the highest rate is 38-odd%. And so sometimes, this is going back to my explanation earlier, that it's better to buy and sell on your personal side than in a company side.
And if you were to use a sourcer like Silks,
yeah,
to buy a deal and they charge a sourcing fee,
yeah, that's
claimable.
Yeah, that would be claimable. Yeah, that goes in as an expense. It's a cost of the purchase, and that you would save tax on that at the retrospective rate.
Yeah. Okay.
Yeah.
So in reality, providing the property is big enough and cash flows enough, you're not really paying a sourcing fee at the end of it once you've.
Yeah, you're saving tax on the sourcing fee effectively. Yeah.
So, as what expenses? Because I know people, we touched upon this last time, but not briefly. People have receipts and all sorts to catch up on an expense to claim it back at the end of the year. On a rental property, what is it that you can actually claim back?
So again, it depends on what you're asking me. Is it for the capital gains tax side, or is it for the rental income side?
Just the rental income side.
So, you know, any insurances, service charges, repairs, not including improvements. If you improve the property, for example, add on an extension, add a basement, you know, do a dormer, that's considered an improvement, and that would be claimable when you come to sell the property.
So that's the misconception there.
That's the misconception, because you'll see a lot of people putting all the improvement costs in the annual repair costs, and that's not claimable.
Because we get it quite a lot. Whenever, for example, we buy a property, yes, I'll spend $5,000 now, make it to a decent standard, then I'll get so much amount of rent a year later. I'll then reconfigure the whole building and it'll cost me 15,000-20,000, and then I'll claim that back. But
that's not an annual expense. That would be an improvement expense, which would be knocked off against capital gains tax.
With all these capital gains tax scaring everybody, Could you share any case studies or any calls or any conversations you've had with your clients that maybe stand out more than others in terms of they might feel more scared than others, or
Not a loophole as such, because
Okay.
we know there's not really a loophole.
Yeah.
And you can't claim back against it. But how would you say it? How could you flip it on its head from a buyer's perspective
Okay.
and try and benefit yourself from that?
So I'm just going to give a very, very simple explanation. If there's two lower rate taxpayers, let's say you and your brother are looking to buy a property and you're working on it together, it's a good idea to buy in joint names because you've got two lots of lower capital gains tax allowances that you can take advantage of. Instead of paying the higher rate, if there's two of you, then the profits are split between two people, and you may well still be in the lower rate tax bracket of 18% instead of paying 24% if it's just on your name on the gain. Or if there's three of you involved, make sure all three of you are owners and partners of that property. Then you've got three lots of up to £50,000 at 18%. Simple as that. So that's a simple explanation. It's a good idea to do it jointly. Then you can make use of each person.
if you can trust the person you're working with.
If you can, yeah. Well, that's if they are involved with the business, which sometimes, like we were talking about earlier, a lot of things are done on a family basis.
Yes,
and
correct.
If it's done appropriately, then yeah, you can take advantage of the lower tax rates. Simple as that.
Say something.
No, I would just like to say, when landlords come to you and they're trying to claim the Macca's receipts and stuff like that on their expenses, it just doesn't work. Just trying to find ways of, have you had anyone in recently, how would I say,
Help me claim my capital gains tax again from
well,
what it was.
yeah, originally when your stamp duty and things like that came in and your capital gains taxes came in, all it did was mean that people negotiated that price off the purchase price of the property.
For you, yeah, they probably want it a bit cheaper.
Yeah, it didn't
now
really
with the-
stop the sales. It just reduced the prices ever so slightly.
And I'm guessing
Are
now
you seeing that?
with the new stamp duty being up to 5%,
Yes.
instead of 3%, that's going to hit your markup even more, isn't it?
Yeah, so if you're buying, if you were to try and buy on a mortgage, I know you don't really buy on a mortgage, but you've got your 25% deposit, and then you're on a £200,000 house, you've got £10,000 in stamp duty, and your legals. You're 45 grand in before you've refurbished it or got any paint on the wall.
Sometimes, I think I might have touched on this before as well, if you're buying and selling a property, you could sell the company that you've bought the property in.
So you don't pay the stamp.
Yeah.
You pay, instead of paying 5% stamp duty. So I could buy a property for 100,000 in a limited company. I refurbish it, I sell it for £200,000, but I sell the company that's holding the property. The buyer only needs to pay 0.5% in stamp duty.
Say someone's got multiple
0.5%.
properties.
Sorry?
Someone says someone's got multiple properties.
It gets complicated, but if it's just one that you're doing and selling on, sometimes it's worth just holding that in a specific company or an SPV as they call it, and then the buyer will only pay 0.5% stamp duty, which
And
you
what
see a
tax
lot
is
of.
applicable to that then? Just income tax once they take over the property?
Nothing to do with the income tax side. It's you'll be doing a transfer of shares and transfer of the directors of the company. And it gets a bit more complicated, but I'm more than happy to talk about that at another date.
Yeah.
You mentioned a few things that are going to be changing, a few things that are coming in. Before we finish off, do you mind touching upon them?
So, new areas, we talked about stamp duty just now.
Yeah.
It's now higher. There's also... there was a lot of talk about the increased rate in residential CGT, which hasn't happened. Other new areas, it's not been as drastic as we actually thought. Maybe slowly different things will come in over a period of time because you can't just, maybe in a simple way shock the system. Maybe different things will come in, like you was talking about the new rules for, tenants, for example. And I've got a lot of people coming in really panicking about the new rules. All of a sudden they've just come in. Maybe rates and changes will come in, but it'll happen over a period of time.
But everyone's feeling the stress from now.
Yeah, I've got the same sort of feeling with people coming in. The main sort of, as you're probably aware of, one of the reasons why people hold properties in companies is because you can claim the mortgage interest relief. The main sort of people that have been hit are higher rate taxpayers with properties on their personal names. And this goes back to one of the questions that you were speaking about earlier on, about a case study. There's somebody who had 10 properties. He was a doctor, consultant, earning over £100,000 a year, 10 properties on his personal name. And sometimes if you've got a mortgage and you're a higher rate taxpayer, it's actually not even worth having those properties on your personal name because you end up paying more tax. So what we did was transfer them into a company without paying capital gains tax and stamp duty. And that's called incorporation relief.
If you don't mind me asking, just give us a number. How much was he saving?
Well, you don't pay any capital gains tax or any stamp duty. The gain is transferred into the shares of the new company that you set up, and you deal with that at a later date. But for the short term, it's definitely beneficial because you haven't had to pay anything whatsoever, and you start saving on the income tax side immediately post transfer.
And what would you do for example, Fayez has told me about a client that he's had that has he hasn't inherited a property, but he's got a property, hasn't necessarily been declaring what's coming in.
Right.
Now he's gone to try and bring himself above board.
Yeah.
And, the penalties for the tax and, and
so
the back
two ways of
dating
doing
and things
this.
like that.
So very often I'll get calls from people saying, look, I've got a letter from HMRC. They've opened up a tax inquiry because they've picked up that I had undeclared rental income. Now, that technically is a tax inquiry, and they will charge you interest, penalties, fines, etc., etc., and it becomes a bit more complicated to deal with. However, there is a scheme called the Voluntary Disclosure Scheme for Rental Income, where you can go forward to the tax office and say, look, I didn't declare my rental income for 6 years. You open up a case reference number, and you can actually pay your undue taxes on the rental income in a favourable manner.
Yeah, and I assume the fact that you've brought this up
because
you've
brought it forward. It's like saying, I hold my hands up. I didn't pay tax for 6 years.
The mentality a lot of landlords have, I didn't pay for 6 years. I don't want to pay the 6 years, but I want to start fresh now. But it doesn't
work because
doesn't work
everything's registered with land registry
Exactly.
and with council tax records, telephone records, etc., etc. It's too easy for HMRC, and it's not right as well, of course, to substantiate how long it's been rented out for. And you'll end up getting yourself in bother.
They've got a right to check everything.
Of course,
So
yeah.
you can't hide.
No, of course
You
not.
can't hide.
So that's just a simple example of a case where you can transfer into a company and end up paying a lot less tax and take advantage of a legal system that the government has in place for transferring properties into a limited company.
Question before we finish off. With all the capital gains tax coming on for commercials, do you think people will start moving away?
Shifting back into residential.
Yeah.
Look, again, one person's commercial could be a lot better than another person's commercial. So it depends on property to property, what the returns are, which I'm sure you can advise on because that's your forte. One commercial property will give you, a return of 8%, another might give you 13%. So if you're losing out somewhere else, you need to look at the overall package rather than commercial is better than residential or residential is better than commercial.
That was the initial mindset of everybody's fair few years ago, commercial over residentials.
Yeah, I try to follow the opportunity cost. So you might get 8% in one place, but it's costing you an additional 5% not having it somewhere else.
Exactly, yeah. So it's each scenario is different, and like I said, that's your specialist area. You'll be able to work out, you'll be able to advise, look, this property's worth it or not worth it. I mean, some commercial properties have huge service charges, for example. A lot of people don't look at them, and that brings your overall...
A question, though, again, sorry, just reminded me. When you own a flat or something that's leasehold, can you claim back the service and the ground rents?
Of course you can, yeah. That's a direct annual expense that you can claim back.
And if you buy your mixed use now as well, you don't pay, is it stamp duty on
It
your
depends
mixed
on
use?
the amount, yeah. If it's a mixed use, there's a certain stamp duty. Again, it's more of a solicitor's question, but there's a limit before you start paying the stamp duty. I believe it might be 150, but we'll need to check into that.
Yeah, lovely. Well, before we go any deeper, we'll let you finish off, and we'll be back shortly.
Thank you.